Good afternoon and welcome back to Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite is Dave Weisberger, Head of Market Structure Research at ViableMkts. Excuse me, I thought I was going to sneeze there for a second. Never had that happen on camera. But back to the point in hand, I'm really excited to discuss this topic. Wall Street is in denial about the potential of cryptocurrency. Why do you say that?
Well, I would say there are some people on Wall Street that are in denial. There are certainly people at almost every firm who are investigating it. They generally have to play advocate inside their firm because there's still this veneer of nonsense, really, that says that, well, Bitcoin's only be good for drug dealers and terrorists or other sort of stuff and money laundering, which is really pretty funny when you consider how much easier Bitcoin is to trace than a dollar bill. In fact, drug dealers would far rather use cash than use Bitcoin. So it is kind of amusing, but there is that veneer, and it gets people to do and say all sorts of silly things.
Well, this is one of my favorite topics that we discussed. Do you think cryptocurrencies, they're confused by the nature of liquidity, market structure, regulation?
Well, yeah, I think that the funny thing is that in my personal situation, it's very interesting because I've been a Wall Street veteran for God knows how many years. I almost hate to admit it. And I spent the last year diving into the crypto space, building the startup, coin routes, whatever. And I see firsthand the confusion on the parts of the people in the crypto space on how markets work, and the as I call it in my article, the delusion on the part of a lot of people on Wall Street saying, we should just poo-poo this is ridiculous. Like the idea that Facebook and Google will stop ads for crypto is insane. Yeah, it's true. There are a lot of scams going on in crypto because, frankly, it's not regulated. And the people on the crypto side are like, we'll self-regulate, but they don't really know what that means. And so when you look at liquidity, like one classic example, it's a simple one, is people in crypto think that if it's decentralized, it's good. If it's centralized, it's bad. Bull. At the end of the day, there are many things that if it's decentralized are good, and if it's centralized, it's bad. And there are other things that if it's decentralized, it's bad, and centralized is good. The most obvious one of those is liquidity. If you look at the New York Stock Exchange, these people got together under a tree. You go to displayed markets. Orders need to compete with each other in order to get the best price. There are retail traders, there are professional traders, there are hedge funds, there are arbitrageurs, there's market makers, there's long-only funds. There's all sorts of people. They usually would be with each other, and if all they did was trade with each other, you would have very poor markets. What you need them is to be brought together. So all the various displayed liquidities need to be brought together. Now, it doesn't need to be in one place, but it needs to be brought together by a network or something.
Right, and that's one thing that you said in your article as well. You compared it to mature markets where liquidity does come from all of these players, retail, institutional, asset managers, all the different types of market participants. But let's also relate it back to more mature markets, and you also said that they're key unambiguous principles of investor protection. And what are they, and why does this strengthen the case for regulation in the digital asset class?
Well, look, at the end of the day, if you're sitting in the cryptocurrency world, what are the things you want to have happen? Let's just go with your wish list and then work backwards. So the two things that everybody wants to see happen are they want to see the SEC approve ETFs in the crypto space, and they want to see institutions trade and acquire and package products off the crypto space. Well, ETFs, the SEC's made two objections. They say, we don't know what the price of Bitcoin is at any point in time, and we don't know where the liquidity is. Well, the reality is you can. I mean, I built a company that literally does exactly those two things, but the way the crypto space works, it's hard to distribute that for profit. And that makes it difficult to get private market participants to actually do that. So you need to be able to get a consolidated view. That's very, very important. The second is institutions. What do institutions care about? Well, they care about fair markets. They know that's not being manipulated. There's lots of allegations of manipulation. Probably some are true and some are false. How do you know? If there's someone who's overseeing it who can actually adjudicate that, there's a way of knowing. Now, there's some self-regulation that can work, and sometimes it's not so easy. What else do they care about? They care about liquidity. They don't want to know what the price is on one exchange. They want to know what the price is across exchanges. That's a big difference. They don't want to think, and there was an article last week about Skype as the primary method. It's either Skype or Telegram. People who are in the know understand that there's all sorts of little chat groups that do a lot of trading OTC. Well, the SEC doesn't want that because they want the market to be consolidated together. They want some notion of reporting. They don't mind negotiated trades, but there want to be some standard reference. These are things which very simple principles like best execution would solve. Now, I'm not saying we should do what we did in equities, which has Reg NMS. I've been outspoken against the order protection rule. But the reason that people like Paul Atkins and I think the order protection rule was a bad idea is because we had the underlying principle of best execution. And if you have that, then companies such as the ones in the crypto space, which allow their customers to pay substantially more than other exchanges are offering, wouldn't be happening. And that's something like this morning, as Bitcoin rallied, the better part of $1,000, there were situations where exchanges were bidding $300 above the offer on other exchanges, and that translates to a best execution violation.
Yes.
If it were governing it, and that would make the markets much smoother. So that's really the point.
I mean, do you think because those spreads are so wide, that's also going to keep market participants out of it for that reason? I mean, that has to be fixed.
See, that's the funny part. The spreads are actually really tight. So like at any instant in time, according to our calculations, even inclusive of fees, the spreads are $30, $40 in Bitcoin, which at $8,000 is not that bad of a spread. In Ethereum, it's $2 or $3. That's inclusive of fees. Now, when we look at spreads on Wall Street, it doesn't include commission or whatnot, so that's actually not even a fair comparison. The fact is the spreads aren't bad. What is hard is in order to access that spread, you have to be able to trade on all these platforms simultaneously, which is why we built what we built, and other people will build what we're building as well. The fact is you need to be able to do that. Unfortunately, that's not common knowledge right now. That's one of the reasons I like talking to you about it, is I want to make it clear.
Well, it is common knowledge now.
Right.
All right. Well, thank you very much for joining me at MarketSite. And traders, thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.